September 2025. The U.S. government closes its fiscal year having paid $981 billion in interest on the national debt. That single line item now exceeds the entire Department of Defense budget of $874 billion. It's closing in on Medicare at $997 billion. Interest payments have nearly tripled in just 5 years, rising from $345 billion in fiscal year 2020. The mainstream budget coverage reports this as a natural consequence of rising debt and higher interest rates. Analysts note that rates increased from historic lows, debt grew during the pandemic, and therefore interest costs rose accordingly. The discussion treats this as background noise, unfortunate but manageable, a problem for future generations to address through eventual fiscal discipline. Here's what the routine interest rising coverage misses. When interest becomes the second largest spending category in the federal budget, it doesn't just represent a line item expense. It represents a crowding out mechanism that forces impossible choices. Every dollar spent on interest is a dollar that cannot fund infrastructure, education, research, defense modernization, or entitlement programs. The government faces 3 options: cut other spending dramatically, raise taxes substantially, or inflate away the real value of debt. None of these options are politically easy. All of them transfer costs to households. This isn't about whether the debt number is too high. This is about recognizing when interest expense consumes so much of the budget that policy flexibility disappears and understanding what historically happens when governments face this fiscal constraint. By the end, you'll understand why interest payments matter more than debt headlines for household finances, how the 4-stage budget crowding spiral reveals where fiscal stress concentrates when debt service dominates spending, what $981 billion in interest, 18.4% of federal revenues, and 3.2% of GDP signal about fiscal sustainability limits. Why 1990s Italy, 1980s Latin America, and post-WWI Europe provide the pattern template for debt service spirals. Where today's budget indicators place the U.S. in the crowding spiral progression. How interest, crowding defense, and infrastructure creates the policy trilemma: cuts, taxes, or inflation. The 5 quiet signals showing Stage 2 transitioning to Stage 3 in budget constraint dynamics. Why this hits your household through program cuts, tax increases, or purchasing power erosion before any dramatic crisis announcement. Let me show you the pattern that repeats every time a heavily indebted government allows interest expense to dominate the budget. Stage 1, interest modest and manageable. Debt exists, but remains a small percentage of GDP. Interest rates stay low, either through genuine market conditions or central bank intervention. Interest payments consume a modest share of the budget, typically under 2% of GDP and under 10% of federal revenues. The government maintains full policy flexibility. It can increase spending in recession, fund new programs, invest in infrastructure, or cut taxes without facing immediate budget constraints. Media and political attention focus on spending priorities rather than debt sustainability. Bond markets show no concern. This is the debt doesn't matter phase where modern monetary theory arguments gain traction and fiscal discipline seems unnecessary. Stage 2, interest accelerates and crowds. Debt grows faster than GDP. Interest rates rise from historic lows, either through inflation concerns or central bank normalization. Interest payments begin consuming 3-4% of GDP and 15-20% of federal revenues. Interest becomes one of the top 3 budget categories, competing with defense, Medicare, or Social Security. Policy flexibility narrows. New spending requires explicit trade-offs against other priorities. Infrastructure and discretionary programs face pressure. The government can still function normally, but growing interest costs create political friction. Bond markets begin pricing fiscal risk through higher term premiums. Media coverage shifts from debt doesn't matter to growing interest costs are concerning. This is where the U.S. sits today. Interest just surpassed defense spending, approaching Medicare, consuming 18.4% of revenues. Stage 3, interest dominates and forces cuts. Interest payments reach 5-6% of GDP and exceed 25% of federal revenues. Interest becomes the largest or second largest budget item, crowding out everything else. The government faces explicit trade-offs: cut entitlements, reduce defense significantly, eliminate infrastructure spending, or raise taxes dramatically. Political coalitions fracture as every constituency fights to protect their programs from cuts. Bond markets demand higher yields as fiscal sustainability doubts intensify. The central bank faces pressure to intervene, either buying bonds to suppress yields or allowing rates to rise and accelerate the fiscal crisis. The economy typically slows as fiscal drag from spending cuts or tax increases reduces aggregate demand. This is the austerity or intervention phase, where governments delay inevitable adjustment through accounting gimmicks and optimistic growth projections. Stage 4, fiscal crisis or monetization. Interest costs become unsustainable. The government cannot credibly fund debt service through normal taxation and spending cuts. Bond markets revolt. Yields spike as investors demand compensation for default risk or inflation risk. The government faces two choices: explicit default or restructuring, which destroys bondholders but provides immediate fiscal relief, or monetary financing, where the central bank prints money to buy government debt, destroying bondholders through inflation rather than explicit haircuts. Both options transfer wealth from creditors to government. The difference is political optics. Default is transparent and dramatic. Inflation is gradual and disguised. Historically, developed economies choose inflation. The cost shows up as purchasing power erosion, rising prices, and real wage decline rather than missed bond payments. Where is the United States today? Deep stage 2, with early stage 3 signals appearing in budget projections and political discourse. The system still functions. Programs operate normally, but the math is deteriorating in ways that compound rather than resolve. In the early 1990s, Italy faced a debt crisis driven by interest expense. Government debt exceeded 100% of GDP, high but not unprecedented. The critical problem was interest payments consuming approximately 12% of GDP annually. For context, the US today pays 3.2% of GDP in interest. Italy at 12% faced a catastrophic budget constraint. Every lira collected in taxes had to service debt before funding any government operations. The Italian government tried raising taxes. Top marginal rates exceeded 60%. It tried cutting spending. Infrastructure crumbled. Public services deteriorated. Neither approach could close the gap because the interest burden kept growing. High debt required high interest payments. High interest payments increased the deficit. Higher deficits increased the debt. The spiral was self-reinforcing. Italy couldn't print its way out because it had adopted the lira's peg to the European exchange rate mechanism. This was effectively a hard currency constraint. When investors doubted sustainability, they sold Italian bonds and lira. Interest rates spiked further. By 1992, Italy faced a choice: exit the currency peg and devalue, or accept a depression-level contraction to restore fiscal credibility. Italy chose devaluation. The lira exited the ERM, lost 30% of its value, and inflation accelerated. Italian bondholders and savers watched purchasing power evaporate. The government reduced its real debt burden through currency destruction rather than explicit default. This is monetary financing through the back door. The exchange rate collapses instead of the central bank directly printing, but the effect on bondholders is identical. Between 1982 and 1990, Latin American governments faced a debt crisis where interest payments consumed 40 to 50% of export revenues. Countries like Mexico, Brazil, and Argentina had borrowed heavily in dollars during the 1970s when commodity prices were high and interest rates were low. When the Federal Reserve raised rates aggressively in the early 1980s to combat U.S. inflation, emerging market interest costs exploded. The mechanism was straightforward. These countries owed dollars, but earned revenue in local currency from commodity exports. As the dollar strengthened and commodity prices fell, their ability to service dollar-denominated debt collapsed. They faced a choice: default explicitly by missing payments, or implement austerity so severe it caused social collapse. Most chose delayed default. They initially tried austerity, cutting government spending, raising taxes, reducing imports. The social cost was catastrophic. GDP contracted 20-30% in some countries. Unemployment exceeded 20%. Inflation accelerated as governments printed local currency to maintain minimal services while servicing foreign debt. Eventually, most countries negotiated debt restructuring, accepting losses for foreign creditors in exchange for sustainable payment schedules. The lost decade of Latin American growth wasn't primarily caused by excessive debt levels. It was caused by debt service payments that consumed such a large share of resources that no capital remained for investment, and the political system couldn't sustain the austerity required to maintain payments. The U.S. isn't an emerging market dependent on commodity exports and can print its own currency, but the pattern is instructive. When interest payments dominate resource allocation, growth collapses, and governments eventually choose inflation or default over indefinite austerity. After World War I, European governments faced massive war debt. France, and Germany in particular, owed enormous sums to domestic bondholders and foreign creditors. The interest burden consumed 20 to 30% of government revenues in some cases. Governments tried orthodox solutions, raising taxes, cutting spending, growing their way out through industrial recovery. None worked sufficiently because the debt levels were simply too high relative to damaged post-war economies. France and Germany eventually chose inflation. They didn't announce, "We will inflate away our debt." They claimed to be defending the value of their currencies while pursuing accommodative monetary policy. The franc and Reichsmark gradually lost purchasing power. By the mid-1920s, German bondholders had lost effectively everything through hyperinflation. French bondholders lost 80% of real value through steady inflation. The political justification was straightforward. We cannot tax citizens at confiscatory rates to pay bondholders when the population is struggling to rebuild from war destruction. We cannot cut spending on reconstruction and social services to service debt. Therefore, bondholders must bear the cost through currency debasement. It's not presented as wealth confiscation. It's presented as economic necessity. This is the playbook. When interest dominates the budget and growth cannot close the gap, governments choose inflation. The costs transfer to bondholders and savers through purchasing power erosion. It happens gradually enough that each year seems manageable. Only in retrospect does the wealth destruction become obvious. The United States paid $981 billion in interest during fiscal year 2025. This exceeds the $874 billion defense budget, the entire cost of maintaining the world's most powerful military, including personnel, equipment, operations, and modernization. Interest also nearly matches Medicare at $997 billion, the program providing health coverage for 65 million Americans. This isn't a future projection. This is current budget reality. Interest just became the second largest line item in federal spending. Only Social Security, at $1.4 trillion, exceeds it. And interest is growing faster than Social Security. Over the past 5 years, interest payments increased 184%, nearly tripling, while Social Security grew 23%. The Congressional Budget Office projects interest reaching $1.5 trillion by 2032 and $1.8 trillion by 2035 under current law. These projections assume no recession, no financial crisis, and interest rates moderating from current levels. Any adverse shock accelerates the timeline. A recession that increases deficits while the Fed maintains higher rates for longer could push interest costs toward $2 trillion before 2030. Interest expense is unique among budget categories. Social Security and Medicare serve 130 million beneficiaries. Defense employs 2 million personnel and protects national security. Infrastructure spending builds roads, bridges, and utilities used by the entire population. Interest spending produces nothing. It's pure transfer from taxpayers to bondholders, domestic and foreign, as compensation for past borrowing. As a share of federal revenues, interest payments reached 18.4% in fiscal year 2025. This exceeds the previous record of 15.4% set in 1996. The government now spends $18.40 of every $100 in tax revenue just servicing existing debt before funding a single program. The Congressional Budget Office projects this rising to 22% by 2035. Relative to GDP, interest costs hit 3.2% in fiscal year 2025, nearly double the 1.7% average from 2019. The CBO projects this climbing to 3.9% by 2034. For context, when Italy's interest costs exceeded 10% of GDP in the early 1990s, it triggered the crisis that forced currency devaluation. The current trajectory is unsustainable, but the question is, unsustainable over what time frame? Bond markets continue buying treasuries. Interest rates, while higher than 2020-2021, remain below many historical periods. The dollar remains the world's reserve currency. These factors provide breathing room. But breathing room isn't the same as a solution. The underlying math, interest growing 17% annually while GDP grows 2 to 3%, guarantees the problem worsens until something forces adjustment. The federal budget contains 3 categories: mandatory spending, discretionary spending, and interest. Mandatory spending includes Social Security, Medicare, Medicaid, and other entitlements, programs where eligibility and benefits are set by law. Discretionary spending includes defense, infrastructure, education, research, and all other programs funded through annual appropriations. Interest is non-negotiable. As interest grows, it crowds discretionary spending. In fiscal year 2025, total discretionary spending was approximately $1.6 trillion, split roughly evenly between defense and non-defense. Interest, at $981 billion, already consumes 61% of all discretionary spending. By 2035, when interest reaches $1.8 trillion, it will exceed total discretionary spending under current projections. This creates the crowding out dynamic. Infrastructure needs $2 trillion in deferred maintenance. Rebuilding crumbling roads and bridges requires funding. But if interest consumes all available fiscal space, infrastructure doesn't get funded. Defense modernization needs hundreds of billions for next-generation systems. But if interest crowds the budget, modernization gets delayed. Education, research, environmental programs, everything competes for the shrinking share of the budget not consumed by mandatory spending and interest. Defense modernization needs hundreds of billions for next-generation systems. But if interest crowds the budget, modernization gets delayed. Education, research, environmental programs, everything competes for the shrinking share of the budget not consumed by mandatory spending and interest. The political economy becomes zero-sum. Every dollar for new programs requires a dollar cut from existing programs. This wasn't true when interest was 1 to 2% of the budget. Then, deficit financing provided flexibility. Now, with interest at 3.2% of GDP and growing, deficit financing just accelerates the problem. New spending today means higher debt tomorrow, which means higher interest the year after, which means less space for spending in the future. The federal government faces three options when interest dominates the budget: cut other spending, raise taxes, or inflate away the debt. Cutting spending means reducing entitlements or discretionary programs. Social Security and Medicare consume $2.4 trillion annually and serve 130 million people. Cutting benefits is politically toxic. Both parties avoid it despite acknowledging long-term insolvency. Cutting defense means reducing military capabilities in a contested geopolitical environment. Cutting non-defense discretionary means eliminating infrastructure, education, research, environmental protection, and everything else government does beyond entitlements, defense, and interest. The 2024 non-defense discretionary budget was approximately $800 billion. Interest is already larger. Raising taxes faces similar constraints. Federal revenues are approximately 17 to 18% of GDP. Raising this to 22% would close the current deficit and slow debt growth. But higher taxes reduce economic growth, which reduces future revenue, requiring even higher rates. There's a Laffer curve effect where rates become counterproductive. More fundamentally, voters resist tax increases. Both parties campaign on tax cuts despite fiscal reality. Inflating away debt is the third option. The government doesn't announce, "We will inflate." It pursues policies that generate inflation as a side effect. The Federal Reserve maintains negative real interest rates, where Treasury yields fall below inflation. This erodes bondholders' purchasing power while reducing the government's real debt burden. It's a slow-motion default. Creditors lose wealth not through missed payments, but through currency debasement. Historically, heavily indebted governments choose inflation. It's politically easier than cutting popular programs or raising taxes. The costs are diffuse. Everyone's purchasing power erodes gradually rather than concentrated on specific constituencies. And inflation reduces real debt burdens automatically without requiring congressional votes. Here are 5 signals to watch through 2025-2027. Signal number 1. Interest expense exceeding $1 trillion annually. We're at $981 billion now. Crossing $1 trillion creates a psychological threshold in media attention. It's also likely to occur in fiscal year 2026, given current trajectory. Signal number 2. Interest is a percentage of revenues exceeding 20%. Currently at 18.4%, this metric matters because it directly measures fiscal constraint. How much of every tax dollar services debt before funding programs? The previous record was 15.4% in 1996. Exceeding 20% would be unprecedented in the post-World War II era. Signal number 3. Interest surpassing Medicare to become the second largest spending category. Medicare is currently $997 billion. Interest is $981 billion, a gap of only $16 billion. Given growth rates, interest likely overtakes Medicare in fiscal year 2026 or 2027. This milestone will force media coverage of the crowding out dynamic. Signal number 4. Discretionary spending cuts accelerating. Congress faces pressure to reduce discretionary programs as interest and mandatory spending consume the budget. Watch for infrastructure projects canceled, research funding reduced, and non-defense agencies facing budget cuts despite increasing nominal spending on interest and entitlements. Signal number 5. Federal Reserve policy subordination. If inflation remains elevated, but the Fed cuts rates or restarts quantitative easing to help Treasury finance deficits, this signals monetary policy subordinated to fiscal needs, the hallmark of fiscal dominance. This pattern appears gradually through dovish policy despite inflation concerns, expanded balance sheet operations, or yield curve control discussions. Next episode, the commercial real estate meltdown. How $2.9 trillion in office debt, record vacancy rates, and regional bank exposure create the hidden refinancing crisis everyone's ignoring until the 2025 or 2027 maturity wall forces recognition. The pattern is documented, the sequence is clear. The only question is whether you recognize the budget crowding spiral before program cuts, tax increases, and inflation force recognition through household budget impacts. This isn't about predicting the future. This is about recognizing when government finances operate outside sustainable parameters and understanding what historically happens when interest payments dominate the budget and policy choices narrow to cuts, taxes, or inflation. All 3 options transfer costs from government to households. The only difference is the mechanism.